Today, we're breaking down two of the biggest stories in the market this week: Elon Musk's massive Tesla pay package and Chipotle's ongoing blame game with Gen Z. This is Common Investor. Make sure to like and subscribe if you enjoy deep dives that go beyond headlines. Let's start with Elon Musk. Tesla shareholders just approved one of the largest compensation packages in corporate history, a potential $1 trillion payout tied entirely to performance goals. The idea is that Musk only gets paid if Tesla's value skyrockets. Sounds fair, right? But when you dig into the details, you start to see why many investors and analysts are worried. The structure may end up rewarding Musk at the expense of existing shareholders. The deal connects Musk's reward to a list of extremely aggressive milestones. Tesla would need to hit an $8.5 trillion market cap and deliver new products like 1 million robotaxis and humanoid robots. For context, that market cap would be larger than the combined value of Apple, Microsoft, and Amazon today. Musk's package could give him more than 25% voting control if all shares vest, meaning his personal influence over Tesla could double. That's why critics, including Norway's $1.6 trillion sovereign wealth fund, voted against it. They argue that while the plan encourages performance, it also exposes investors to massive dilution and consolidates power in one individual. If Tesla issues all the shares tied to this plan, the company's outstanding shares could rise by roughly 12%, directly reducing existing shareholders' stake. That's the dilution risk. Even though Musk only earns the payout if Tesla performs, every new share issued reduces the value per share for others. Supporters say Musk built Tesla into what it is today, and he deserves to be rewarded for future innovation. But from a fundamental perspective, this isn't just about motivation. It's about balance. When one person can control a quarter of the world's most valuable car company, accountability becomes blurry. You can't measure leadership purely in dollars when it also affects corporate governance. To make this package look fair, Tesla would have to deliver extraordinary growth, not just in EVs, but in robotics, AI, and transportation. Analysts at Bernstein and Wedbush estimate Tesla would need annual revenue above $1 trillion to justify that market cap. But with global EV demand cooling and profit margins tightening, that target seems more aspirational than achievable. If Tesla misses these milestones, the dilution remains while the upside vanishes. It's a classic high-risk, high-reward setup, one that may look visionary now but could backfire later. Investors aren't just betting on Tesla's business model, they're betting on Elon Musk himself, and that's a concentrated risk. Now let's talk about Chipotle, because this one's wild. After reporting 7.5% year-over-year revenue growth in Q3 2025 to about $3 billion, Chipotle executives blamed weaker sales on Gen Z and millennials eating out less. They said younger customers are strapped with student loans and shifting to grocery meals. That explanation didn't sit right with me. The stock has fallen nearly 33% over the past year, and same-store sales are flat. You can't blame a generation for that. When you look closer, customers are complaining about smaller portions, higher prices, and worse service. Those are operational choices, not generational trends, and they directly erode customer trust. Chipotle's argument is that external pressures, inflation, debt, and tighter budgets are behind the slowdown. But even in this economy, younger consumers are still spending heavily on experiences that feel worth it. They'll pay a premium if the product feels fair and consistent. The company's problem isn't Gen Z's wallets, it's Chipotle's perceived value. Social media is flooded with videos comparing old portion sizes to new ones, and those optics matter. Once a brand becomes the face of shrinkflation, recovery is tough. If leadership doesn't pivot soon, either through better pricing transparency or improved quality control, they risk permanently alienating their most valuable demographic. Both stories share the same theme: accountability. At Tesla, it's about leadership concentration and whether the payout serves shareholders or just one person. At Chipotle, it's about owning up to execution failures instead of blaming customers. As investors, we need to separate narrative from numbers. Just because something sounds rational, performance-based pay, or Gen Z spending slowdown, doesn't make it true. The data always tells the real story. If you look beneath the noise, one company is risking dilution for ambition, and the other is risking reputation for excuses. This is Common Investor, where we track not just what companies say, but what they actually do. Like, subscribe, and I'll see you in the next breakdown.